Welcome, everyone. So, you've probably seen a financial report before, right? You see all the columns line up, the numbers look clean, and you think, okay, great, this company must be in good shape. But what if I told you that those perfect-looking numbers could be telling a complete lie? Today, we are going beyond just balancing the books. We're going to learn how to find the truth hidden inside the numbers, which is the skill that separates a bookkeeper from a real business leader.
All right, let's just jump right in with a question that I promise you could save you or your future company a fortune one day. In all your accounting classes so far, the goal has been about precision, right? Getting everything to balance. But what if that very act of making the numbers balance is actually hiding a massive, critical mistake? It's a tricky concept, but a flawless report can absolutely be a perfect lie. And today, we're going to learn the techniques to spot it. Okay, so before we can become what I like to call financial detectives, we have to start by admitting a fundamental truth. Errors are going to happen. It's inevitable. I mean, think about it. No matter how great your systems are, the sheer number of transactions in any business, thousands, millions, means that little mistakes are bound to creep in. It's like being a chef in a busy kitchen. You can be the best in the world, but you might still burn something occasionally. The job of a good manager isn't to pretend mistakes don't happen. It's to have a system to find and fix them before they ruin the whole financial picture. I really want this to sink in for a minute. Think about a company like Amazon or Walmart. We're talking about millions upon millions of transactions every single day. Every single one of those is a chance for a small human error, a little typo, a decimal point in the wrong place, an expense put in the wrong category. Each one of those seemingly tiny slip-ups, from the moment it's first written down to when it ends up in the final report, can grow into a huge problem. It can mislead everyone from the CEO to outside investors. That's exactly why we need a systematic way to hunt for them.
So where does this hunt begin? Well, our first line of defense in this investigation is something called the trial balance. It's a really useful fundamental check to catch certain kinds of mistakes. But, and this is the part I really want you to hear, it is not a magic bullet. It's not foolproof. In fact, one of the biggest rookie mistakes an analyst can make is trusting it too much. So let's take a closer look at what it can do for us, and maybe more importantly, what it can't.
The easiest way to think about a trial balance is like one of those old-fashioned two-pan scales. You know, for justice. It's all based on that core principle of accounting, double-entry bookkeeping. Every transaction has two sides. So on one side of our scale, we put all the accounts with debit balances. Think assets and expenses. On the other side, we put all the accounts with credit balances, liabilities, equity, and revenue. And if the scale is perfectly balanced, it means our debits equal our credits. It's a great first check, but that's all it is. It's just the start of our investigation, not the end.
Now this is what it looks like when things go wrong. You can see our scale is totally tilted. The debit side is sitting at $10,000, but the credit side is at $11,000. This is a big flashing red light, and alarm bell is going off. Everything stops. You cannot move on and prepare your major financial statements until you figure out exactly what caused this. It's like finding out the foundation of a house you're building is cracked. You don't just keep building, you stop and you fix the foundation first.
All right, detective hats on. When our trial balance is off like that, we don't just start randomly flipping through pages. That would take forever and be incredibly inefficient. No, we work smart. We have a list of what we call the usual suspects. These are the most common types of errors that are almost always the cause of the problem. Let's go through the two most wanted culprits.
So our first two suspects are recording errors and posting errors. A recording error happens right at the beginning. It's a typo at the source. You made a sale for $500, but you accidentally typed in 50. The mistake happened right in that initial journal entry. A posting error is different. It's more like you wrote a perfect letter, but then you put it in the wrong mailbox. The initial entry was totally correct, but when you transferred or posted that information into the final ledger, you put it in the wrong account. Knowing this difference is huge because it tells you where to look for the mistake.
Okay, everybody, listen up. We are about to cover the single most important concept in this entire discussion. Seriously, this is the idea that's going to elevate you from just being a number cruncher to being a true strategic thinker. It's the secret that will help you avoid incredibly costly mistakes down the line. This is what separates the novices from the pros. You ready? Let me say that one more time, because if you remember nothing else, remember this. A perfectly balanced trial balance does not mean your financial records are accurate. It is a dangerous trap. It gives you this false sense of security, and so many people fall for it. It can lead to absolutely disastrous business decisions. Just because the two sides of the scale are level doesn't mean you've put the right things on the scale in the first place.
So you're probably asking, how is that even possible? Well, there are three main ways this happens.
First, an omitted transaction. Let's say you just completely forgot to record a $5,000 sale. You missed the debit and you missed the credit. So the books stay in balance, but they're completely wrong. Second, a duplicate transaction. You accidentally record that same $5,000 sale twice. You added the debit and the credit 2 times. It still balances perfectly, but it's still wrong. And then there's the third one, the most sneaky and dangerous of them all, the error of principle.
An error of principle is like putting diesel fuel into a car that takes regular gasoline. The engine might run for a bit, but you're causing serious fundamental damage. In this example, let's say your company buys a brand new truck for $50,000. That is an asset, no question. But what if the accountant mistakenly records it as an expense, like vehicle maintenance? Well, the debit and credit still balance, but your financial statements are now telling a completely false story. You think you made $50,000 less in profit, and you think you have $50,000 less in assets. You have a totally warped view of your own company's health.
And this is exactly where it all becomes real. Put yourself in this manager's shoes. You get the report for the month. It looks good. It shows a nice profit. So you think, great job, team. Let's approve those performance bonuses. Then, a few days later, your controller comes into your office and says, we have a problem. That $50,000 truck we bought, it was accidentally expensed. Suddenly, your profit vanishes and becomes a loss. And you just paid out thousands of dollars in bonuses the company couldn't actually afford, all because you trusted a report that looked perfect on the surface.
So what is the major takeaway here? Is that as a future leader, a manager, an executive, an entrepreneur, your job isn't to just passively accept the reports that are put in front of you. Your job is to be a healthy skeptic. It's to learn how to question the numbers, to understand their limitations, and to ask the smart, tough questions to get to the real story.
This right here is the mindset shift that will define your career. A trial balance is like the spell checker in a word processor. It's a fantastic tool. It will tell you if you misspelled a word, but has absolutely no idea if you use the wrong word entirely. That's where you, the human, the critical thinker, come in. You have to look at the whole picture and always be asking, does this make sense? Does this story add up? Because at the end of the day, the quality of your decisions will never be better than the quality of the data you're basing them on. So, from now on, whenever you look at a financial report that seems just a little too perfect, I want you to remember this lesson. Don't fall for that illusion of perfection. Be the financial detective. Ask the questions no one else is asking. And never ever forget that the numbers on the page don't always tell the whole story. The real truth, the insight that leads to brilliant decisions, is often found by figuring out what the numbers aren't telling you.